Hello, everyone. Welcome to my channel, Accounting Simplified. And today we are going to be looking at chapter one of Fundamentals of Financial Accounting, the foundational course for financial accounting, the first financial, the first accounting course for accounting majors, and some finance students also take the course. Um, Business Decisions and Financial Accounting is the first chapter, and that is what we are going to be looking at today. Thank you. So, why are we looking at this? The work that accountants do, the work that accountants do every day, is to generate reports or generate financial information that will help users make important decisions. That is what they do every day, and that's why the first chapter is for you to see the big picture of accounting, the bigger picture, the usefulness, um, and that's the reason. And you have to understand then that there will be, um, we have to understand how the accountants do it, why and how, and we'll see that accountants work in different forms, kinds of organizations, and companies can be formed in different forms, legal forms. A company can be a sole proprietorship, that is, the owner of the company is not a separate entity, is the same as the company. The law views the person as the same as his business. We have the partnership, corporations. There are other forms, you know. You also have not-for-profit organizations and the rest. But the most important thing to note is that the basic principle of accounting is the same regardless of these forms of organizations. So regardless of how the organization is formed, whether it's a sole proprietorship or it's a corporation, the basic principles that underline how accountants perform their job is the same. It is the same. And that's what we are going to be looking at. Who are those that use this information? The information that accountants provide. There are different stakeholders. There are many of them, but just to mention a few, you have creditors, those who lend money, the lenders who lend money to the business or who lend resources to that organization. They use financial information. They want to know, should I lend, will I get my money back if I'm lending this organization money? Investors who want to invest in the business, they want to be sure they're going to get a return on their investment, and that they won't make an investment and 1 year later the company goes bankrupt, you know. Directors, managers of the organization would need financial information produced by accountants for them to be able to make decisions as to the strategic objectives, future long term objectives of the company, and whether the strategies that have been set in the past, whether they are working. You have government through regulatory authorities, and they also make use of this financial information for governmental purposes, for regulatory purposes, for tax purposes, and the rest. So, what are those basic principles that are common to all accountants, to all organizations, on how these accounting information is prepared? Um, you have what is called the basic accounting equation. The basic accounting equation is the most important concept in accounting. Why? Because every single transaction obeys this accounting equation. Everyone, every single transaction, this equation is always in balance. Is always balanced. I mean, is always balanced. Like, if there is an increase in assets, then it's either there is another decrease in assets corresponding decrease in the same asset, in another asset, but on that same side of the equation. Or when there's an increase on the left side, there's an increase on the right side as well. Maybe the liabilities go up, or maybe the equity goes up. You know, a simple example is when you finance the purchase of a vehicle for the business. You borrowed money to buy a vehicle. Your assets went up by the value of the vehicle, but you borrowed money to pay for the vehicle, so liabilities went up. So it's an equal transaction. Oh, you say, oh, what if I don't borrow money? What if I pay cash? Well, an asset vehicle went up, and an asset cash went down by the same amount. So this equation must be balanced at all times. Is either opposite events occur on one side, or the same direction of events occur on both sides of equal magnitude. Every transaction a company, a business does follows this accounting equation. And mathematically, you can represent it by, moving liabilities to the other side, so that you say asset minus liabilities equals to owner's equity. Another way to really understand this equation is to look at it this way: assets are the resources you use in the business, but it doesn't mean you bought those assets with your own money. Just look at yourself as if you are the company, you are the owner, and you are the company yourself. Look at it that way. Now, you have assets, right? Those are the those are the resources you use in running the business. It doesn't mean you bought it by yourself. Sometimes you borrowed in you borrowed money from lenders to get it, or you financed the asset. So what that means is it's not every resource that you are using that actually belongs to you. So the accounting equation basically is saying assets, resources that you're using, equals resources you borrowed, which is liabilities, plus resources you own. That's the ones you bought with your own money, owner's equity. So an owner comes in and says, I want to start a business with $100,000. Yes. What if it's not enough to start that business? So it starts with $100,000. He bought some things, some resources, some equipment with that money, but it's not enough. So he borrowed, let's say, $50,000 from a bank more to be running the business. Now, in total, in the company, they have resources totaling 150,000. That's the total assets, right? But some of them were borrowed. So liabilities is 50,000, and the owner contributed 100,000 owner's equity. So total of 150,000. So basically, the resources you use equals resources borrowed plus resources owned. Another way to put it, or just to explain it in personal terms now, you have $100 in your pocket, but out of that, you borrowed $40 from for example John. So that means you don't actually the $100 doesn't belong to you, because you are owing John $40. So assets $100, everything in your pocket, but liabilities, you are owing someone $40. So plus $60, which is what actually belongs to you. So owner's equity is assets minus liabilities. That is $100 that you have in your pocket minus what you have to pay to others, which is $40, which gives you $60 of what is your own money. Every transaction. Give me any example, and I will show you how they align with that basic accounting equation. Um, but someone might say, what owner's equity? Yeah, is it only when the owner contributes money? Not entirely. So at the beginning of the business, owner's equity is what the owner contributed. But over the years, from period to period, the business is making money or losing money. So owner's equity is not just what was contributed. The owner owns a right to the profits of the business. And if the business is making losses, who bears the consequences? The owner. So that means the owner's equity is actually what was contributed, which is this common stock. That is what was contributed. Common stock. Let me change this to the pointer. Hopefully that will help. Um, hopefully that will help someone better. Yeah, let me change it to. Let me change it to a brighter color so someone can be helped. You see, common stock. That is what was contributed by the owner. At the beginning, yes, owner's equity is the same thing as what was contributed. But from period to period, some profits or losses were being made. An accumulation of all profits that have been retained in the business belongs to the owner. And if it's a loss that has been accumulated, yes, the owner will still bear the consequences. It reduces the value of what he owns in the company or she owns in the company, you know. And so owner's equity is the contribution, which is common stock or what you call contributed capital, plus the residual income, the net resources, the net profit that have been accumulated over from the beginning of the business up till the moment we are talking about, you know, it all belongs to the owner. So owner's equity is common stock plus retained earnings, not just earnings, retained earnings, because some earnings may not have been retained. Some earnings could have been spent could have been given to the owner as dividends or as drawings. So, but the ones that are retained in the business is belongs to the owner. You know, retained earnings. So, how do you calculate the retained earnings? The earnings that have been retained from the beginning of the company till now is so. For example, you are in year 5. At the beginning of year 5, which is the end of year 4, we had some retained earnings. But during year 5, we made some money. So automatically, it means that our retained earnings at the end of year 5 is what we had at the beginning of the year plus any new money we made, right? And if we lost, then retained earnings reduce. But then plus any money we make. But what if we pay out of that earnings minus whatever we pay out? What you pay out to owners is usually called dividends. So retained ending retained earnings, which we can decide to put it here, ending retained earnings equals to beginning retained earnings plus net income minus dividend minus what you paid out. So what we have at the beginning plus what came in less what went out, which makes more sense. So that's how you get retained earnings, which you then plug into your owner's equity, uh, your owner's equity equation to get owner's equity, which owner's equity is now what comes back into the basic accounting equation. Okay, let's see how these come together. So we've talked about how you know the basic accounting equation is the principle, right? The general principle. But it is also the principle, it is also what drives every report that an accountant prepares. every financial information, every statement, every report that an accountant, it drives it. The major reports are called financial statements. You have the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. Those are the four major financial statements. So if someone says prepare financial statement, those are the four things they are talking about: the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. Let's start. So let's see how the basic accounting equation ties into each of these statements, especially the first three statements. Look at the first statement, income statement. Yes, I know the formula is there already on your screen for you to see, but even let's assume the formula was not there. Income, that's what you earned, right? What you have earned. That means you must have subtracted whatever you spent from what initially came in for you to say, okay, this is what I earned. So income statement, even based on the name itself, looks like a statement that will tell you everything that came in, everything you earned, and everything you spent, and then it gives you the net is what you earned. So income statement is net income equals to revenues minus expenses. What you earned minus what you spent, and that gives you what you have left for the company. The balance sheet is basically the accounting equation. The balance sheet is assets equals liabilities plus stockholders' equity. And we've talked about retained earnings before. So there's a statement of retained earnings, which just is the same formula. Ending retained earnings equals to beginning retained earnings plus net income minus dividend. And the fourth financial statement of cash flow, is about cash. It's just about cash. I'll explain that better later. But I want you to see how the first three statements tie into one another. So let's look at it this way. The basic accounting equation is the same equation that you have for the balance sheet, right? Assets equals liabilities plus stockholders' equity. Why? Because that's what gives us a picture of how the business looks today. Every single day you prepare a balance sheet, for that day is the picture of the company. It tells you what the company is worth. If you decide to buy the company from the owner, that stockholders' equity is telling you what it's worth. What that owner would get if they were to sell the company today. And so tomorrow it will be different, but as of today, this is what this company is worth. And that's why that's the basic accounting equation. Because every other one from the other two financial statements, they tie into that equation. What do I mean? Look at the statement of retained earnings. Ending retained earnings equals beginning retained earnings plus net income minus dividend. Before you can calculate the ending retained earnings, you need to know your net income. And before you can know your net income, you need to know your revenues minus expenses, the income statement. So before you can actually prepare the balance sheet, you need to prepare the statement of retained earnings, because you will use the retained earnings to calculate stockholders' equity. It's retained earnings is a part of stockholders' equity. So you will need to use it to calculate stockholders' equity. You cannot know what your stockholders' equity is unless you know what your net income is. You cannot know what your net income is unless you prepare your income statement, which is revenue minus expenses. Can you see how they tie together? So those three are you use the information in one another. So, but when you go to the fourth one, statement of cash flow, that's the only one that is different. It's different because you are only talking about cash. You're not talking about the income that maybe you sold goods to Nancy. Nancy said, "Oh, you sold goods of $50 to me. I don't have $50 now. I'll pay you $20. I'll pay you $30 next year. In the income statement, you would say, oh, I sold goods of $50. My revenue is $50. But in your statement of cash flow, you only got $20 from Nancy. So, statement of cash flow is only about cash. It's all about cash. What cash did you pay for your regular day-to-day activities? That's operating activities. Good. What cash did you pay or did you make from investing activities, in buying equipment, in selling equipment? You know, that's investing activities. And what cash did you make from issuing new stock or borrowing money, or paying dividends? What cash did you use up in doing that? That's financing activities. So that's how you calculate the cash flow. You list the cash you use for each of these activities and you add them together. And that gives you a statement of cash flow. And then you do a reconciliation. When you add them together, that's your change in cash, right? You add it to the beginning cash balance and it should give you your ending cash balance, which should be in your balance sheet as well. You see, that is how that goes. And we've mentioned before that all these four financial statements are used by certain stakeholders for making decision. What does a good financial information look like? It has to be relevant. Relevant. It has to be relevant. For example, if you have a company, a software company, that you want to report results of the business, if you start reporting, if instead of reporting the purchases that are being made by the purchase of the softwares that are being made, if instead of reporting the actual amount that people are buying to make, people are paying to get this software, if you suddenly go and estimate what it will look like if you were selling hardware, then it's not relevant to your business. It's not relevant to the decision making of those users. Another thing is that it has to be faithfully represented. Faithful representation means that there is no intentional error, intentional misstatement. It doesn't mean that every financial statement is 100% accurate. No. But it means there is no intention to mislead others in those reports. So it has to be relevant. It has to be faithfully represented. Another characteristic that is close to, included in faithful representation is what you call reliability. People can rely on it. Those are characteristics. There are other characteristics as well. It must be timely. It must be verifiable. It must be understandable. It must be comparable. Those are other characteristics as well. But the two most important ones, relevance, faithful representation. You can also include reliability. But the two most important ones, relevance, faithful representation. So we've talked about the basic principle of financial information, right? But practically, what does it look like? Let's take an example. Crown Incorporated had the following information from January to December 2019. So we're given all this data for different accounts and for January to, I believe it should be, it's December 2019, January to December 2019. But then you go here, you are given more information, and you see, merely seeing this, you know what it means. Cash received, cash paid, cash paid, cash received. This, most likely, this part of this information will be for your cash flow statement because it's only talking about cash. But let's continue. Required. Prepare all four financial statements. 2, was the company profitable? Where did you find this information? What proportion of profit is paid as dividends? Which financial statement provides this information? 4, which group of users are the major source of financing for the company? creditors or stockholders? 5, did cash increase or decrease? And by how much? Which financial statement? Let's start from number 1. Prepare all 4 financial statement. So I go back to the information we are given, and I just want to give you a shortcut that can help you when you are preparing these financial statements. Of course, there can be complex ones that will require you, doing some calculations before you can put them in the exact format that you will use. But but this is not one of those. The values have been given to you for each of these account traits. They didn't involve additional information that will make you to need to do some calculations. So, what is the shortcut that I'm talking about? It's important for you to look at each of these accounts. When you want to prepare more than one financial statement, it's better to look at each of these accounts and label them. Label them according to what you need to do. Label them according to what you need to do for you to get them across. You see, accounts payable is a liability. Maybe before I continue, just to digress, there are some text, especially international text, will talk to you about elements of the financial statement. Elements of the financial statement. Those elements are some of those we've mentioned before. Some will call them 5. I personally, if I were to write a textbook tomorrow, I'll write 7. I'll start writing 7. Why? Because some of them you will use together, but some you will use alone. But let's look at the 5 first, and then I will tell you my additional 2. So, revenues, expenses, assets, liabilities, owner's equity. Let me go back to the financial equation so you can see it. Revenues, this, expenses, assets, liabilities, stockholders' equity. Those are the 5 elements of the financial statement. You can break stockholders' equity down. You can break it down to contributed capital and dividend. Contributed capital and retained earnings, basically. Contributed capital and retained earnings. You can do that. But have it at the back of your mind that most texts, I am the one giving additional 2 because I feel like it's better to just have 7. But most texts will say 5. Revenues, expenses, assets, liabilities, stockholders' equity. This is 5. 1, 2, 3, 4, 5. Okay. Now we can go back to our question. And the shortcut I'm talking about is that you pick each of these accounts and you label them according to which element they fall into. So, accounts payable, payable. That means it's a liability, right? Accounts receivable. That is money that someone is owing you. That's an asset, right? And this is an expense. Cash is an asset. You just label them. And what that does for you, let me show you what I've done here. See how I've labeled each of these accounts. What that does for you is that you can go back to your equation and say, okay, the first statement I'm preparing is the income statement. Income statement is net income, is what I need to get, equals revenues minus expenses. So I have to just go to what I have labeled and just list all the revenues. This is the only R, revenues. This one is RE, retained earnings. But revenues, list it. I only have one. Only one of these is R when you look at it. Revenue, list it. Net income is revenue minus expenses, right? So look at all the E's, all the expenses. 1, 2, 3, 4. 4 expenses. List them. You see that I only have 3 here. That's because income tax expense cannot come here. But I will explain why. So you have your revenues, you have expenses, and then you just subtract your expenses from your revenue, and that gives you your income. Now, that should normally be net income, but remember that every, well, our nation collects taxes. Almost every nation in the world collects taxes. So that's an expense. Income tax is an expense. But we don't put it together with other expenses. Why? Because in most situations, you don't know what the income tax expense is yet until you prepare this report. So usually we don't know what it is. We will have this figure, 3,020. Then there will be a tax rate that has been given by the IRS or by the government, depending on which country. And then that tax rate, you multiply by this difference in revenue and expenses, and that gives you your income tax expense. So normally you have to calculate it. In this question, we are given, so we can just plug it in, but don't make the mistake of putting it under this section, because normally you should have calculated it. So we're fortunate enough, we don't have to calculate, we are given. So that's why we call this income before tax. In most reports you won't see income before tax, you see earnings before tax. It's called EBT. And where there is interest, you have EBIT, in earnings before interest and tax. But in this case, we have EBT, earnings before tax, and then we have our income tax expense, which is given to us. This is it. 780 income tax expense is given to us. Mostly you have to calculate it, and then you deduct it, and you have your net income. So our net income in this case is positive. That's why I put this note here. Tax is calculated. But in this case, we are given, we use what we are given. $2,240. Good. People are usually tempted to go to the balance sheet next. We've prepared our income statement. The second financial statement, the balance sheet. People are tempted to come here first. But I will advise you, as you work on in your accounting journey, don't prepare your balance sheet next after the income statement. What do you prepare next? A statement of retained earnings. Why? Because this retained earnings figure, whatever you get as your ending retained earnings, is what should come to your retained earnings here. So instead of you preparing your balance sheet, getting to this point and having to use calculator to calculate your retained earnings, why don't you? I did all of this in Excel, so I didn't bother using any calculator. But why don't you prepare your statement of retained earnings first, immediately after getting your net income? Because that's the only thing you need. Dividend has been given to us. We have our beginning retained earnings. We can calculate our ending retained earnings. I know I put June 30 here. That's just a mistake. It's December 31st. So that means you have this beginning retained earnings plus net income minus dividend gives you ending retained earnings. And then we can take this figure and then we can come and prepare our balance sheet. Remember, I've labeled each of these according to whether they are revenue, expenses, assets, liabilities, or stockholders' equity. So, good. Since I've labeled them, all I have to do is just look at where's an asset? Where are my assets? Balance sheet is assets equals liability plus stockholders' equity, right? So I can just go, okay, first assets. And then I pick everything that has A in front of them. Apart from this, you can only pick one cash. Remember, and this balance sheet is at December 31st. So because it's at December 31st, we don't use the first one. We use the ending cash balance. And so cash, 10,600. Accounts receivable, that's another asset. We list all the assets. We total them. Assets equals liabilities plus stockholders' equity. So we need to do our liabilities. And we can just pick anything that has L. Accounts payable, notes payable, together, those are your liabilities. And then stockholders' equity, and then that's SE. What are the things that have SE? SE. Let's see. Common stock is here. S. Common stock 15100. That's this. And then retained earnings. This is dividend. We've used it in calculating ending retained earnings. We just need the ending retained earnings. We've used this up. You can't just pick this. We need the ending retained earnings, not the beginning and not the dividend. We have used those two information in the statement of retained earnings. So we just need the ending retained earnings, which is this 26,400. And we plug it in here. And you can see liabilities plus stockholders' equity 55,250, and it matches our total asset 55,250. That's how you prepare your balance sheet. So we've successfully prepared the income statement, the statement of retained earnings, and the balance sheet. Now we need to prepare the statement of cash flow. This is different. Remember, I said the second portion of the information we're given is for the cash flow. Why? Because I could easily say cash received from, cash paid to, cash paid to, cash received from, dividends paid to, anything paid, received in terms of cash goes on your cash flow statement. And you can also label that in advance. There are three activities for cash. They are either operating activities, our regular day-to-day activities, or they are investing activities, long-term projects, long-term investments, or they are financing activities. And so you can categorize each of these based on what they are for. Issuing common stock, those are owners, right? We're getting money from them. We are giving them share certificates. So we are trying to obtain finance by issuing shares. That's a financing activity. Cash paid to purchase equipment. Equipment is a long-term asset. And anytime you are spending on a long-term asset, that is an investment. So that's an investing activity. Cash paid to suppliers. Oh, without your suppliers, there's nothing to sell. There's nothing to manufacture. So this is a regular routine activity. That's operating activities. Cash received from customers. No customer, the business is dead. So operating activities. Cash received from sale of long-term asset. You buy long-term asset, that's an investing. When you sell them too, that's an investing activity. This is an investing activity. Dividends paid to stockholders. Now you're paying dividends to the owners of the business. Why? Because you got money from them in the first place. They are the owners. They must have contributed to the ownership. So dividend paid to them is financing activity. So what I do, since I've labeled them, is the segment your statement of cash flow into the three different activities. Operating activities, O. So look for O. We only have O for these two. So we have cash received, and I have it here. Cash paid to suppliers. And so we have a difference, a positive difference of 2,750. That means we made actual cash, not just money in terms of income. We made actual cash positive in the previous year. Investing activities, cash received from sale of long-term assets. Cash received from sale, those are long-term assets. And so when we now sell them, we are getting a return, we are getting back from what we've paid initially. So that is an investing activity. And then when we actually buy new equipment, that's an investing activity. Cash paid to purchase equipment. Cash financing activities, the F's that I have there. Cash received from issuing common stock, and then dividend paid to shareholders. Take note that when you have a cash inflow of cash, that is positive. And when you have an outflow of cash is leaving the business, you're paying out. That's a negative. That's an outflow. And that's how you see the positive sign, the negative sign here because it's paid. Positive here because you receive cash. Negative here because we paid cash. Positive here because we received cash. Negative here because we paid cash. And that leaves us with a net change of $3,230. When you add that to the beginning cash, this is a reduction, right? So when you reduce the beginning cash by that change, you have 10,600, which if we want to verify, we see that it matches our cash in the balance sheet. That's what we want to do. This is a form of reconciliation. It helps us to be sure that our balance sheet is good. That you know, that's what it does. Um, let's answer the remaining questions. Was the company profitable? From the word profit itself, you remember that there used to be a statement called profit and loss account. Profit and loss account is what became our income statement. And so automatically, for you to know if the company is profitable, you have to go and look at something that has to do with income. So you have to look at the income statement. That's where we have to look. So where did you find this information? Well, you can answer that before you even know whether it is profitable. You can only find it in the statement that talks about income. And so when you look at the income statement, you have a positive net income, right? So that means we made money. That's a gain. That means we made something. Um, so the company was profitable. That's the answer to that question. And the information could be found in the income statement. Number three, what proportion of profit is paid as dividend? Which financial statement provides this? So you have to look at which financial statement has dividends and talks about profit at the same time. You know, there's no dividend in the income statement, right? So we can't, even though it's talking about profit, but we can't say income statement because there's no dividend there. So which statement includes dividend and profit gives us information about this? The statement of retained earnings. The statement of retained earnings tells us how much dividend is being paid and how much income was made. You see that the ratio is like we are even paying dividend that is more than the net income during the year. You know, that's what it is. There is less, the dividend is more. So this reduces our retained earnings because we paid out more than we earned this year. That reduces our retained earnings at the end of the year. What other question do we have? Which groups of users are the major source of financing? Which group of users are the major source of financing for the company? Are they creditors or are they stockholders? Where do we get that? Which statement will tell us that? Liabilities, creditors, who are liabilities, or stockholders? Which one is the major source? The statement that puts together these two things is the balance sheet, because the balance sheet is the basic accounting equation, right? So the balance sheet is telling us, let me pull it to the balance sheet, that assets equals to liabilities plus stockholders equity, right? So that helps us because now it's saying who is financing this company the most. These assets, 55,250, who owns most of them? Is it the owner or the borrowing, the lender? And we can see the total liabilities is what? Is less than 15,000. This is 13,007 something. That's the total liabilities. And the stockholders' equity is 15,000 plus 26,000, that is 40,500, 41,500. So that means the stockholders' equity is way more than what we borrowed. So the major financier are the stockholders, are the owners of the company. They are the ones who are financing the company in a major way. Let's go back to the questions. Did cash increase or decrease, and by how much? We can see that easily. We can look at the balance sheet for that, but you only see the cash at the end. That doesn't tell you much unless you actually look into the cash account. But for you to know that the cash increased or decreased, simply look at the statement that talks about cash, the statement of cash flow, the end of this statement is the net change in cash. You easily see whether your cash increased or decreased. In this case, what did it do? There was a negative change in cash, right? So that means it decreased. It decreased by 3,230. 3,230. That's the decrease in cash. That's the decrease in cash. Then it says which financial statement, of course, the statement of cash flow. If you have any question, please feel free to reach out to me via accountingsimplified@gmail.com. Accountingsimplified@gmail.com. I mean ACCTING simplified@gmail.com. You can also book a personal session or a group session. Go to accounting-adura.com. accounting-adura.com. And we'll see how we can better be of help to you. Let me know for questions, reviews, and comments what you would like, question you would like me to solve. Email me at accountingsimplified@gmail.com, and I'll get back to you. Until next time, study, study, and study. Thank you, and have a good week.